us, and we'll take that point forward from the market standpoint. Sanjeev, so much of hue and cry about impending correction, and what we got was just 10% from the recent top on mid cap, small caps. And between 14th of March and now, which is the week, we have clawed back more than half of it, especially non-banking PSUs. Is it over before it even began?
Yeah, good morning, Ajay. Well, that is what typical bull markets are. You can keep feeling the fear when the markets correct, but they had reached zones where there was overbought readings on a lot of stock sectors, and the SEBI diktat, the overall play on stress test on mutual funds, all that meant that an artificial correction took place. Remember the words artificial corrections never last too long, but they are painful. But in bull markets, the retracement is sharper than you thought. And Ajay, we live in strange times. The Dow, the Nasdaq, the S&P, the Japanese Nikkei, all are in a upward momentum. New highs are across the board. So I think that it's about time India started to smell the coffee, and we think that the result season will be boding extremely well. Now everything is on earnings, and short-term macro can be, but we think the economy as such is doing very, very well. And now as we get more clarity on elections and so on, you should see one more rally coming before the election. And I am very, very positive now on some of the mid caps, particularly the PSUs. I have been bullish across the board on oil marketing companies, on REC, PFC, some of the banks, particularly say a bank like Union Bank. I think numbers will be stand out. We had a buy on this closer to 55, 57, then 100, 140. I still think Union Bank is headed to 200. And selectively, we think stocks are going to do extremely well. Cement, gold lenders, REC, PFC, your federal, the mid-cap banks, and I think that the broader market will again start to do well, but it's going to be the Nifty which can actually spearhead on the back of Bank Nifty, which I think can be a huge outperformer. Falling yields and lower inflation bode well both for the indices and for the banks.